Good afternoon, everybody. Good afternoon. How's it hanging? How's it hanging? Wednesday, August the 20th. Let's turn the volume down on that silly TV. I am an associate member of T3 Trading Group, which is an SEC registered broker, dealer, and member of FINRA. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure. I got out of JOBY, which was in for quite some time. That turned out to be a very successful trade overall. I got out of Serve. I got out of one other thing, I think. Can't remember. Jumai. I got out of Jumai. And that's it. I traded AMD alongside. That was a day trade, though. Took a few other day trades, but within the confines of stocks that I was already in. All right, let's assess it. So Spicer closed down 0.3%, but well off their lows. Qs here closed down 0.6%, also very far off their lows. The IWM closed down 0.3%. TLT's up a bit. Dollar's flat. Gold up, but range bound. Oil had a good day today. And Bitcoin finished green, which I think is a little bit notable. All right. So let's talk about it. So, it's an interesting market, right? Because this market is still very much being hallmarked by dispersion. This is still an environment that is about dispersion. Yesterday seemed like the whole world was falling apart, and then we're doing the afternoon meeting, and the RSP, the equal weighted S&P, was green. Because the whole world was not falling apart. It's just the most looked at stocks in the AI sector that have led us up higher over the course of the last few months that are over-owned got hit really hard, and they just rotated the money elsewhere. So, I keep trying to remind people when we look at the SPYs, this is what I was saying in the morning meeting today, the S&P is not bearish. Heck, the S&P is not even neutral. The S&P after yesterday, and honestly still after today, is still bullish. It is still bullish. This is still a very bullish looking chart. If we closed below 636, if we closed below the 21 EMA, I'd be singing a little bit of a different tune. I'd be saying, hey, the S&P has gone from bullish to neutral. But we had some incredible downside tails in the market today. We got bought back, the market's red, but we got bought back pretty big off of the intraday low. And again, it just really seems like it's all about these more over-owned stocks that are seeing some money come out of them, because it's exactly that. They're over-owned, and you're combining that over-ownership with maybe some negative headlines that people are trying to pull from OpenAI and things like that. But the SPYs here, they honestly look great. This is a potential pivot low for upside continuation within the confines of the broader uptrend that they've been in. Nice downside tail. We broke through that 636, but couldn't hold beneath it. So SPYs look fine. Today's low will be really important going forward. So today's downside tail give us a reference point. If bears really are going to maintain any control, if bears are going to turn this bullish market into something that's a little bit more neutral or bearish, you got to get below today's low. So that's a major reference point. And then yesterday's high is important, and the all-time high is important. It's kind of where we're at with the SPYs. Look at the Qs. I'm going to have a similar story, except I was arguing that the Qs are the one index in the morning meeting this morning that I think are more neutral. They've lost a lot of their bullishness just, again, with some of these big Mag 7 leaders kind of leading us lower. That impacts the NASDAQ the most. So the Qs had fully lost the breakout day that was back here on August 12th. They really closed right at the 21 EMA yesterday. They closed below it today, though there is a big downside tail. To me, the QQQ looks very kind of range bound at this point. Still looks, it looks neutral. It does not look bearish, especially with the downside tail today. 560, which is an important support level, held, and you got a big downside tail. You lose today's low, you start to retest the August 1st low, then all of a sudden we can have a conversation about the NASDAQ actually beginning to look more bearish. But this looks neutral. And the IWM closed above 225. 225, really important resistance level from June. We had multiple false breakouts of 225 back in June. Even after yesterday, it was just a pullback to the ADMA on the daily chart and still closed above 225. Today we traded underneath 225, but we closed above it. The IWM honestly looks bullish still. If we can get below 225, I'd say we look neutral, and you really need to fully negate at least the August 12th low in order for the IWM to look bearish. So we haven't played that bullish, bearish, neutral game, which is a game that I love to play just because it gives us the right perspective on how we should be focusing on our trading, if we should be more focused on longs, shorts, or something in between. And here we are at the end of the day, and I will make the argument to you that the SPYs are bullish, the IWM is bullish, and the NASDAQ is neutral. Though the structure of things has certainly changed a little bit. We've got these big downside tails in a lot of those important leading stocks and at the index level, but we're also off of highs. So what is the next step for this market? Is today the pivot low? Was today the dip after we had a couple days of selling that ends up being the absolute pivot low and a continuation of the uptrend? Or have these last couple days signaled that things are changing, and today some of those leading stocks like Nvidia and Palantir just got so downside extended that they had to get bought back a little bit, and really it's just a kind of an oversold bounce in those leading stocks that is within the confines of a change of market structure that is going to lead to a new low. I don't have the answer to that question. You know, I'm personally still leaning on the bearish side, even though that just defies what I was just saying about the bullish, bearish, neutral nature of the market, right? Bullish, neutral, bullish is where we're at. I'm personally still of a more bearish thought process because I'm also, in my mind, including things like seasonality, systematics, things like that. But what's really going to probably answer the question on whether or not this market becomes more bearish by breaking today's low, or this is the pivot low of the uptrend that leads to new highs, there's a good chance that it's going to be Jackson Hole on Friday. So that's where we're at. We'll see what happens tomorrow. I would kind of expect, honestly, that tomorrow is going to be within the range of the last two trading sessions. Last two trading sessions have had a pretty wide range, so I don't think that's a really big call. But, you know, Thursday, tomorrow being the day before Jerome Powell's speech at Jackson Hole, it would make sense to me if the market is just a little bit more range-bound, staying between yesterday's high and today's low, to then set us up for Powell's speech, which could potentially break us in one direction or the other. So, you know, we'll see how it plays out. But for a week that is pretty devoid of major macro news, we've had some pretty good price action these last couple of days, right? I was remarking when I was on the virtual trading floor, like, man, I love this price action. I love this price action so much better than what we've mainly dealt with for these last few months, where it's just been grind up and grind up and grind up. It's just there's so much more opportunity. There's so much more day trading opportunity. This is much better price action in my opinion, and we were really able to take advantage of it. You know, so it started with us getting further downside follow through, but then we were able to be selective and call out, you know, cute longs and cute shorts throughout the trading session. I think we called out a cute extension long off the 955 pivot low. That worked fine. You know, I fully liquidated whatever I bought into this little up move, I think. Then we called out this pivot low at 1015. Same deal, just for a snapback to the ADMA. Maybe I'll hold a little bit for more than that. But what I was saying as we got to the ADMA here, as we got to highs, I was like, guys, make sure that you've covered enough of your longs, that you've sold enough of your longs, that your risk is fully covered. So if you get stopped out on a new low, you're still making money on the trade. And then finally, the third one here was really what turned out to be the bottom of the day. Couldn't know that you can't know that any of these are potentially going to be the bottom of the day or not. All you do is you execute that extension pivoted as it comes in. you book your profit, you get your risk covered, you book some extra into the equilibrium zone, and then if it fully reverses, maybe you're holding a small bit of your position for that bigger move. If it doesn't, you sold enough where you're going to make money on it. And then next thing you know, I don't think I called the short out. No, I did. I called out the short on this one here because we were actually extending up at that time for the cute short. For me personally, because I am still net short, I've got a lot of short exposure. This was just a real quick hit for me. Shorted the Qs basically, but it was the same signal. I was fully out by the ADMA. I basically did the exact same thing here on this move, and then this move I don't think I was focused on it, to be honest. I think I got focused on something else. But great trades on both sides of the market at the index level, also at the individual stock level. I know I was focused on buying the dip in AMD, which worked out pretty well for me as a day trade. I know some of you guys were looking at NVIDIA at a certain point. Some of you guys were looking at Palantir at a certain point. I actually feel like the Palantir long was the most difficult one that some of you guys were looking at. It eventually seems like it worked out for the people who took it. For me personally, I really wanted to see that like one more bigger downside capitulation move where you actually like break this downtrend to the downside and accelerate on high volume. I think I said, even when the thing was at like 146 or 147, I was like, if this Palantir can accelerate down to 140, not only will I get out of my short, but I'll actually probably flip long. And again, it's just an extension trade. Like it seemed like people were shocked in the afternoon that some of these things were bouncing back as much as they were. And yeah, the market bounced back a little bit more than I thought that it would, but you shouldn't be surprised if the market bounced back, and you definitely shouldn't be surprised when you see Palantir trading at $142 with the ADMA at 170 on a day 6 to the downside, with some of the biggest downside extension I've seen in this stock in a very, very long time. That's going to give a really big bounce back. And I remember saying multiple times early on the way up, I was like, guys, stock is bouncing back. I am still shorted. I didn't get fully out because it didn't get to 140. But if you're like layering back heavily into Palantir or heavily looking for that day trade short to come in, just have a little bit of perspective. The ADMA on the daily chart is like 169, 170. Palantir could easily snap back to the low to mid 160s, create a pivot high in that area, and then fall apart further. This is, an oversold bounce for the most part. Maybe it turns into something more. I mean, that's been the history of the stock for quite some time, is that it turns into something more. Personally, and I know I've spoken about this a bunch of times publicly now, I think the stock is cooked. I think it's done. I really think that this high is the high, unless the market starts going completely bananas to the upside. I think that this thing is done. But that's not to say that this thing isn't going to have bounce backs along the way. You drop from 190 to 140 in 6 days and have that degree of extension, you're going to be getting big bounce backs in this thing. It's a very high beta stock. So for me, it was all about covering and reducing my position on the way down. By the time I got to lows, I didn't get all out, and I certainly didn't flip long. I would have a little bit further down, but I got pretty light by the time this thing was making its absolute low of the day, with the whole thought process of, I'll look at sizing back up in this thing in the 160s. And yeah, I did reshort some stock kind of slowly and incrementally on the way up because that's how I trade, kind of for cash flow and everything else. But, as far as, have a good one. As far as like looking to really layer back into the stock, I think you need to be looking for this thing to satisfy its downside extension on the daily chart, and then take it there. So I'm trying to think if I got anything else, and then just kind of cleaning up a few other things. I had some great call outs. If I can give myself a pat on the back, on Monday with the Microsoft short, I still have a little bit of that left, looking for the move to 500. But I got out of the Jumai short that I shorted on Monday, up above $8. I got out of that today. That was a good little trade. I got out of the Serve, which I shorted at like $10 and then added on the way up a little bit. I got out of that into the down move today. I finally got out of this JOBY. I was super heavy in this thing up here. Added back really big into that gap up when they said they actually landed a plane for the first time. 14 had really been my target, and I honestly think my target's shallow. It could and probably will see $10 to $12 again, but fully liquidated that one. Yesterday I got out of the NNE, which I had shorted on Monday. We had called out the OKLO short on Monday through 70. Just a lot of really good stuff. Setups on Monday that swung through for a few days that worked, combined with some good day trades today. I think made for what was overall a pretty good trading session with pretty good action. So that's all I got. Happy to answer any questions like always. Jane Street discloses a 5.4% passive stake in CoreWeave. Interesting. From Scotty Too Hottie. What's the stock that Josh mentioned was trading at 40? Same business as Palantir. So I'm not 100% sure what Josh referred to, but what I'm assuming he referred to is the Palantir note, the Databricks, the Palantir note that Citron's been talking about, basically saying, I posted it in the VTF pre-market this morning, Scotty, if you want to go up and find it. I posted exactly what Citron said about it, but Citron, which turned bearish on Palantir at the top, shout out to Andrew Left on that one. Hell of a call. I mean, it's been overvalued for a long time, but he finally came out with the trade and the price target at that point. Basically, he's pointing to Databricks as what he says is a competitor, a similar business, but he says is actually a better business, and says that if Palantir was trading at the same valuation as Databricks, he actually thinks that Palantir should be at a lower valuation than Databricks. But if it's trading at the same valuation as Databricks, which is a similar company, then Palantir would be trading at 40. And I don't know, 40 seems a little extreme to me, but personally, I think somewhere between 60 to 80 is a reasonable price on where Palantir is from a valuation perspective. It's just that, until Databricks IPOs, until OpenAI IPOs, you just don't have anything else to invest in if you are forced to invest in the public market. So I think that has led to a lot of buying in Palantir that may go to other places if more companies had IPO'd, plus just the meme style of the stock, right? It really became a meme name as they were buying this thing up. But I've been saying it for a while. Palantir is not a bad company. It's a great company. It just, in my opinion, has no business at $190 and 190 forward PE. It's just a little bit silly. So yeah, I mean, $80, $100 could be reasonable. $60 even if the whole market were to deteriorate a little bit. 40 seems a bit extreme, but that's my thought process. From Scotty, can you explain a DOO and an RDR from this morning? Sure. So it's the same thing. DOO, RDR, they're the exact same thing on the short side or the long side. So it's not necessarily a DOO is on the long side and RDR is on the short side. These are interchangeables. Really, it's RDR. Really, it's 80-20. All right, so here's just the quick history, then I'll explain what the trade is. There is a trade that was traditionally called an 80-20 trade. I'm not 100% sure why. But it traditionally was called an 80-20 trade. Scott Redler of T3 was a great trader. That's one of his favorite trades. And Scott, who is a good friend and a great guy, so I would never down him, but he may or may not have a large enough of an ego to often refer to himself in third person and also name trades after himself that already exist. He decided to rename the 80-20 trade basically after himself because it's his favorite trade. So he named it the Red Dog Reversal. And then at some point in the past 5 years or whatever, I don't exactly remember when, as almost a joke here in the VTF, as a play off of that, some of the guys in the VTF decided to rename the trade after me and call it the DOO, aka the Derrick Oldensmith overthrow. All three of these trades are the exact same trade, just with different names. So I just have to explain the history there. So if you ever hear anybody refer to something as an 80-20 trade, an RDR trade, or a DOO trade, it is all the exact same trade. Now that I've said that, let me explain what it is. I wish I had a good example off the top of my head. Let me try to pull up some charts really quick to see if I've got a good example of an RDR. I don't know if anybody else has one on a daily chart or even on a smaller time frame that I can use. Open yesterday, yeah. Open yesterday, I think is a decent example. Okay, so basically, what an RDR trade seeks to do is take advantage of extension, and Scott calls it a red dog reversal. I actually think it should be called a red dog retracement. But saying retracement doesn't sound nearly as cool as calling it a reversal. So it's a contra. I hesitate to say contra trend. It's really a contra momentum trade to take advantage of extension up or extension down, seeking out mean reversion after a really big move. Okay, and the prerequisites of that trade are you need at least two really strong bars in a row or really weak bars in a row. And traditionally, this has always been done on a daily chart. More recently, in like the last couple years, I've actually started to experiment with this trade a little bit on 5 and 15-minute charts with good success as well. But you really got to do it at the right times. And it's about taking advantage of extension. But traditionally, this is based off of a daily chart. So you get at least 2 really strong days in a row. The reason why this open is a good example but not a perfect example is because the second up day, so if you're looking at my screen share, August 14th is day 1 up, big up day. August 15th is technically a positive day, but it's not like a really good momentum day. So it doesn't set the RDR up very well for day 3. But day 3 was so strong that it actually ends up setting it up. So you get like really strong day 1. Day 2 is positive, albeit not really strong. And then day 3 here is really positive. So this becomes a day 4 RDR. And basically the trade is you either gap above or intraday trade above the previous day's high. Why is that significant? It's significant because you've got a lot of extension at that point, right? So by this point, after 3 strong days in a row, the high of day 3 is $3.95, and for reference, the ADMA is down to $2.86. So you're looking at a $3 stock that has over $1 of upside extension, right? That is a lot on a percentage basis. And then on day 4, in this situation, it gaps up above the high of day 3. Sometimes doesn't gap up above the high of day 3. Oh, Reddit. I just did this in Reddit a couple days ago, so Reddit's another example. Let's go back to Reddit in a second, because let's just continue with the open example, but then I'll explain Reddit, because I literally just did this trade like 3 days ago, and it worked out fantastic. I did it in Reddit. But on this example for open, on the day 4, it gaps above. So the trade is to short through the previous day's high versus today's high as your stop loss. That's basically it. So on day 4, you would have shorted back through the previous day's high, so you would have shorted back through $3.95, and the stop loss would have been $4.10. So you take, in this example, $15 worth of risk, and your target is a correction back to equilibrium. What is equilibrium? Equilibrium, as I define it, is a space between the 8 and 21 EMA. That's your technical equilibrium. So the upper band of equilibrium in a strong stock is the 8 EMA. So target number 1 would really be the 8 EMA. Target number 2, sometimes we use like the midpoint between the 8 and 21 EMA. Target number 3 would be the 21 EMA. By then the trade is fully fulfilled itself, but maybe you keep a little bit extra in case the retracement down actually becomes a reversal. But really all you can expect and really be looking for is a move to that target number 1, which is the 8 EMA on the daily chart. So in this example, if you took that 15 cents worth of risk yesterday and you're shorting at $3.95, it got to the ADMA and fulfilled its target today at $3.06. So in this example, you risked 15 cents and you made 90 cents, right? Not bad. And that's just a target one. This thing could give even further follow through. But if anybody took that and open, hopefully you booked a bunch of profit as this approached the ADMA on the daily chart for open. So that's open, and then I was going to go over Reddit. So Reddit was like a day 10 RDR, which that's pretty rare. And it might have even set up and not really worked back here on August 7th, right? And honestly, it looks like it set up and also didn't really work on August 5th. So big day 1, big day 2, day 3 actually triggers the RDR. You short back through versus that high. This, by the way, guys, is why we always, when we're taking counter trend trades, try to get our risk covered as quick as we can and not be too greedy, because you have such a high probability of counter trend trades failing. But you know, if you tried to short Reddit on the day 3 RDR, if you shorted back through the previous day's high with what the low turned out to be, hopefully you got 1-to-1 as a risk reward at lows. Hopefully you're able to cover your risk and then you get stopped out of it. And then it goes again. And honestly, that might reset up the count where you're not taking it on this trade. You could, I think, maybe because of the degree of extension. But same thing, if you took it, it wouldn't have really worked. Maybe it worked enough to get your risk covered versus as high. It looks like it's close. Either you're getting your risk covered or the trade just failing. And then it goes, 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 and then it goes. And then on August 18th, which is the day that I shorted it for the RDR trade, the trade ends up working. So this is either a day 1, 2, 3, 4, 5, 6, either a day 7 RDR, or if you want to include this entire up move into your count, it's like a day 11 RDR. You know, so it's not like it has to be day 3 or it has to be day 5. It has to be at least day 3. You have to have at least 2 big up moves, and then it's day 3 that you're looking for the trade. Otherwise, you probably don't have enough extension. And that also circles back to, you hear me talk about it all the time, I don't like trading day 2s, right? This was the day 2 on Reddit back here on August 4th. I don't like trading day 2s. Day 2s are typically not a good risk reward on either side of the trade. The long is too late. The long is too late. Even if it works. And guys, I don't care about any one individual result on one individual trade. I care about, I take 100 trades, I take 1,000 trades. What is the result over that, right? So day 2s, even if it works, I don't care if it continues, I'm not buying it. I'm also not shorting it, and I don't care if it fails, I'm not shorting it. Because the day 2, you have a bad risk reward. You're chasing if you're buying a day 2. That inherently sets you up with a bad risk reward, even if it works. But if you're trying to short a day 2, it's too early, even if it works. It's a recipe for getting run over. It's like not extended enough. It just broke out yesterday. There's a good chance it gives even further follow through. By the time you get to day 3, then those longs are getting a little bit tired at that point, and you might be able to get that short for that retracement because you probably have a lot of extension. In this case, Reddit was berserk in the month of August. And like I said, this is either a day, I forget, 5 or 11, depending on where you want to start your count, and was actually even further accelerating up on those last couple of days into it. So back here on August 18th in the pre-market, I called out Reddit as for the RDR short. And this is a good example because unlike with open, which gapped above, this one actually did not gap above. It opened within the range of the previous day. Then it traded up through the previous day's high, created a pivot high intraday, and then it came back down through. And when it comes back down, that's when you're shorting it versus that previous day's high. And it's really important to note with this trade, and this is an important aspect of it, you're going counter trend on the trade, but you're shorting it in the direction in which it's moving on that time. So instead of just like shorting Reddit at 222 because you're like, hey, it's extended, and you're shorting it on the way up, and then by the time it gets to 252, you're completely run over. Instead of just shorting this on the way up, you're shorting it on the way down. So at least you have that on your side. You're shorting it on the way down. That's the preference. Even when you're going counter trends, you want to short or buy in the direction in which things are moving. So that Reddit was a really good one. And then these can work in the other direction too. It could be the exact same thing. I'm not going to bother try to look for an example, but you get 2 big days to the downside. Day 3 comes in. You get that big downside tail. It snaps back through the day 2 low. You're buying it versus that downside low, and you're looking for continuation to equilibrium. And on the reward side with this Reddit, for me personally, because I have a lot of shorts on, I didn't want to be too aggressive. I was all out by the 80 EMA on the daily. But this thing went all the way down to the 21 EMA today, so it perfectly, fully fulfilled a deep price correction in the 21 EMA. Like that was a great trade. You know, we were able to short this thing at 248. I was actually cheating on it. You know, sometimes we've talked about cheating on trades a little bit. Sometimes it's a good idea because you get a better risk reward. Sometimes it's a bad idea because you lose money on something that you wouldn't be in otherwise. In this one, I was cheating and I was shorting it at like 250 on the way down, I think, intraday. And if you took that trade at my price, you had $3 worth of risk. And if you had a game plan all the way down to the 21 EMA, you could have moved all the way down at 205 today. It's phenomenal risk reward. It's a great trade. Traditionally, it's a stock trade, but you could execute it however you want. You know, you could execute it with options in different ways also. And I have done it with options, but traditionally it's a stock trade. Yeah, typically if I'm doing it, I'm trading stock. That's what I do with Reddit. Once in a while, for certain circumstances, I will do it with options. Appreciate the question, Scotty, and the follow-up, TG. The size that I use, it really depends on the circumstance. I don't have a specific amount of size that I use every time. I'm judging the extension for sure. Like what is, you know, for me, I would say, just generally speaking, size is always the last part of the equation. The first thing I'm looking at is how much space do I have to give it in terms of risk, and what's the reward potential on the downside for this trade. You know, I'm saying downside because it's a short, and then I kind of back into how much size I want to actually take off of that. Trying to think about the right way. Trying to think about the right way to explain that. So, so I don't always necessarily do what I recommend. In terms of, I definitely have recommendations on how traders should trade as a percentage of their account. And sometimes I have to balance when people are asking me questions, like what I really think the right answer is to the question that I would like kind of more recommend versus what I sometimes do. So what I typically recommend to traders to do is to have a maximum daily loss that is a percentage of their account. Typically anywhere from like 2 to 5% based on the trader. Let's just use 5% because it's an easy number. So in a given day, over the course of all the trades that you're going to take in that day, your maximum daily loss is, let's say, 5% of your account. So if it's a $100,000 account, then it's $5,000, just again to keep the number simple. And then I then would say that you take that $5,000 and then you can divide that amongst trades. How you divide that amongst trades is what I call risk skew. And risk skew, I actually think, is an extremely important concept in trading and trading profitability. And basically what risk skew is, quite simply, is that you risk a higher percentage of that $5,000 in a trade that has a better risk reward and higher probability of success, and a lower percentage of that $5,000 in a trade that has a not quite as good risk reward and probability of success, but is still obviously a trade that's worth taking, right? Not all trades are created equal. And that's the concept of risk skew. And then what I teach newer traders to do is to grade their trades, like a letter grade, and then you give the letter grade a percentage of the daily maximum loss. So maybe like the ultimate A plus setup that's got a phenomenal risk reward, a high probability of success, everything's on the side of the trade. Maybe you want to risk your entire day on that ultimate A plus trade, and I think that's okay sometimes. But then maybe your B minus trade or something like that is you're risking like a quarter to a third of your daily maximum loss. So in that case, you might be risking, if your daily maximum loss is 5% of your account, which is a little bit aggressive, on a B minus type of trade, maybe you're risking a percent or 1.5% of your account on that. So you're risking significantly less. So circling back to like this Reddit example, what I think the right thing to do is you assess, like, all right, I'm shorting 248 versus 252, or I'm shorting 250 versus 252, whatever, or 253, whatever that execution is, and the ADMA here is all the way down at that time, which would be your first target, at 229. So it's like, all right, if I'm shorting 250 versus 253, I've got $3 worth of risk for $20 worth of reward. That's a pretty good risk reward. What's the probability of success? I would actually argue that it's pretty good at that point. Day 11 to the upside. I would argue that the market was turning to be on the side of that trade as well. So you've got some good layers of probability there. What you don't have is capitulating volume. I'd like to see more volume confirmation there. So that's just kind of a strike against it. So that would have me reduce the grade of the trade a little bit. But I think it's a decent enough that maybe it's like a B plus trade, So if you risk 5% of your account in a typical day, maybe on that trade you'd be willing to risk, 2%. So if $5,000 is your daily maximum loss, maybe on that trade you're willing to risk $2,000. So you're still leaving yourself some ammo for some other trades in the day. It's not an A plus, but it's again worth taking. And that's just the risk reward to the first spot. So that's usually how I kind of recommend it. For me personally, I'm doing that, but I'm also factoring in that I'm in, at that time, because that's the same day that I shorted Microsoft. It's the same day that I shorted NNE. It's the same day that I shorted Serve. Might be the same day that I shorted Jumai. And on top of that, so I had 28 positions on, and like 24 of them were to the short side. So I'm factoring in like I'm already massively short. So I'm probably taking the portfolio into account, and therefore taking even less size on it. And like I said, I was 100% out of this by the ADMA on the daily chart. I didn't hold for any of those deeper targets. That also just had to do with me taking the trade a little bit lighter, just because of other things that I'm accounting for when I'm actually executing that trade. But that's kind of how I do it and how I think about it. So appreciate the question there, TG, and the follow-up. Good stuff. All right, cool. Popping over to the YouTube. Oh, hold on, we got one more from Scotty. I flipped long on Palantir today. I got great execution at 144, spot 75 as it crossed the 9 EMA on the 5-minute. I sold way too early. How can I be more confident in this? So confidence in and of itself is a trading psychology related term, right? That's what you're asking me, right? Basically what you're asking me is, how can I improve my trading psychology to be able to make more on my winners for whatever the reason is? And I would say a couple things to you. One is we need to be very, very careful about looking at what a stock does after the fact, after the trade is all said and done, and saying, oh my god, I shoulda held a larger percentage, caught a bigger move, blah 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 blah. Sometimes you shouldn't, right? Let me tell you one thing I'm not doing, to circle back to Reddit. I am not looking at my Reddit trade where I got out at like 2:30 and saying to myself, oh man, I should have held this for the bigger move down to 205. I should not have held it to the bigger move down to 205 because I was not game planned to hold it down to the bigger move of 205. I can't look at charts after the fact, regardless of what anything does after I took the trade, and say that I should have done something different because the trade worked or didn't work. Now, I could review my trade and I could say I should have game planned this better because I missed the following factors and therefore I should have been heavier in the trade. But I think it's a very dangerous thing to look at trades that work or trades that fail and say I shouldn't have gotten in it or I should have held it further, because again, it's not the single instance of a trade that matters. It's if you took that long in Palantir 100 times, what are the results going to be over the course of that 100 times? And that's what you really need to be making the adjustment on. So that would be the first thing that I would say. The second thing that I would say is almost always when we're dealing with anything that's related to trading psychology, learning to hold your winners longer, you get out of your winners too early, similar but different, you struggle to hit out on positions that are moving against you because you think it might bounce back in your favor. These are all trading psychology issues. There's so many of them. But most trading psychology issues, I find the resolution to them is usually the same resolution. And that resolution is to have a game plan and follow it, right? So let me take a half step back and go through really briefly my favorite series of statements that I invented myself about what it means to be a successful trader, right? So what does it mean to be a successful trader, right? A successful trader is someone who is consistently profitable. That's the term that we use, a consistently profitable trader. Well, the only way that you can be a consistently profitable trader is if you are consistent in regards to your actions to the market. If you're doing different stuff every day, you're not following similar strategies, you're not following similar game plans. One day you're a scalper, the next day you're a swing trader, the next day you're a tape reader, the next day you're a technical analyst. There is no consistency in that, and you will not be a consistently profitable trader. So the key to being a consistently profitable trader is to be consistent in regards to your actions to the market. The only way that you can be consistent in regards to your actions to the market is to have rules that enable that consistency. Rules for any and every trading situation that you may find yourself in. And then those rules are manifested in your game plan, right? The game plan is basically a totality of trading rules that you put together for the situation that you find yourself in, for how you're risking money and how you plan to make it. And then the final part of it is to have the discipline to be able to follow those game plans consistently over time. And there's two really, really hard parts of trading, a trader's career. One is making it through the learning curve. The learning curve is figuring out what type of trader am I, what types of trades do I want to be involved in, and what time frames, and creating those rules, and then creating the game plans around those rules. That's the learning curve of the business. It's very hard to get through that. Number two is then having the discipline to be able to follow the game plans consistently over time, because the market will do everything it possibly can to mess with your psychology. And we have a recency bias with our trading. We look at the trade that I got out of and it continued as a mistake. It might not have been a mistake. We look at the trade that I got into and lost money on as a mistake. It might not have been a mistake. We work in a game of probability. Inherently, when you work in a game of probability, it means that a percentage of really good trades that are within your trading edge that you take will fail. That's by definition how it works. So when you're asking about, like, how can I be more confident on this trade, what I would say to you is, what was your game plan when you entered the position at 144.75? What was the game plan? What was the stop loss? What was the game? Because a game plan is going to have a risk management side of the game plan, and it's going to have a reward maximization side of the game plan. And if your reward maximization side of the game plan said that you're supposed to be out by the 21 EMA by 147.50, I'm just making this up, and you got out at 147.50, that means that you did a good job. You had a game plan and you followed it, and it doesn't matter that it went to 156 after the fact. It doesn't matter, right? The question isn't how can I be more confident in it. The question is, did I have the right game plan? Did it make sense that I got out at, and again, I'm just making up this number, I don't know where you got out, but did it make sense that my game plan was just to get out at the 21 EMA at 147.50, or am I missing something in my edge, therefore in my rules, therefore in my game plan, that I need to make an adjustment for to account for the fact that I can make more on these types of trades? And maybe that is actually the real question, right? So the things that you should be asking yourself, Scotty, is one, did I have a good game plan that covers all aspects of anything that this trade could have done after I was in it? Two, if the answer is yes, did I follow it? If the answer is no, well, that's a problem, and you got to figure that out. And then finally, question, I guess, 3 is, was that game plan, now that the trade is all said and done, actually the right game plan? Was I missing something? Should I have taken into account a little more the extension that exists on this daily chart, and therefore been having a game plan that was a little bit greedier? Maybe that is the answer on how you could have further maximized reward in this trade, is that you actually missed something in the development of that game plan that said that you should be going for more. So that's a fantastic question, and I hope my answer helps. For sure. Over to the YouTube from Steven. Crazy day today. Hope everyone had a good session. Yep. Thank you. I did. Gave back some profit from my highs, but still was a good day. From Cyril, it was day 2 to the downside. I was surprised at selling at the beginning of the day. Didn't see like it for a long time. Yeah, we've gotten so used to the market never going down, right? And even and like you just said, all it was a day 2. I kept having to remind people all day today, the SPYs are not bearish, right? The SPYs at this point are not bearish. There's no reversal here on these SPYs. As far as I'm concerned, they're bullish as long as we're above 636, is the 21 EMA on a closing basis. The Qs are below, yes. Which levels will you be looking for a potential QQQ short? I don't know. I kind of feel like I need to get through Jackson Hole to give myself a little more confidence. I think if we were to bounce back further tomorrow to 570, let's say between 569 and 572, that would be an area that I would potentially look to revisit some shorts. But I'm probably not going to be in a rush to do anything significantly new tomorrow. I'm probably, going to be primarily waiting to get through Friday at this point. From Scholastic Pie, Intel seemed to have caught a bid on some recent news, but today's down move seemed excessive. Is there any chance of a breakout given its shaky financials? I mean, you have SoftBank and the U.S. government apparently taking stakes in it, so that's a good reason to be bullish on it. I mean, look, this is another one that just got really extended 2 days ago off that news, gave a shooting star. Now it's pulled back to the 80 EMA on the daily. I don't hate looking for a long in this thing between, very broadly, 22.50 and 23.25. I think you could look for a long on that. From Steven, you said you're bearish on the systematics. Is that from the vol funds or CTAs? If I said I'm bearish, I want to take that statement back. I'm not bearish. What I am saying and what I've been saying is that the systematics are no longer a tailwind necessarily. My understanding of the systematic positioning right now is that it's pretty deep in the pool, but could even still buy a little bit more. I think that the risk on the systematics is to the downside, but you have to trigger that. You need to start seeing realized vol days in excess of at least 0.75%, which we did not get again today, by the way. It's a down 0.3% day, to see vol selling come in. And the CTA sell trigger is like 620 26 SPY equivalent, basically. And that's like the trend following CTA sell trigger. So I can't say that I can't say that I'm bearish on systematics. I can say that the risk is to the downside, but that risk has to be triggered, and they could even buy a little bit more from where they still are. But they're no longer they're not the underlying bid that they were in May, June, and July. That's for sure. When they were just had gotten short in April and were just having to buy back insane amounts of stock in that period of time. They could be buying back a little bit here in late August, but they're pretty much done with their buying. But just because they're done with their buying does not mean that they're sellers. They're only sellers if you can get an event that triggers the market, right? And that circles back to what we keep joking and saying in the VTF regularly in all capitals, because you're stealing it from Charlie McGilligan, is when crash. When crash? When crash? You need that positioning to be fully in, but you need a catalyst to hit. You need that catalyst to trigger the systematic selling, and then it can feed on itself. Ideally, when skew is right, when VIX skew is also right, to create a real VIX pop. I have been in the camp for the entire month of August that August was going to be a little bit choppier and range bound, and I think it's been pretty fair so far, and I still think that's the truth. Because you got to keep in mind, you're getting $5 to $6 billion a day of buying from corporate buybacks right now, which is a massive number. So you don't have the systematics buying in the way, but corporates are buying at a rate that is greater than they have ever bought before, ever, actually, right now, probably. 1.1 trillion over the course of 2025 is expected, and this period of time, as we are getting out of earnings season, is the biggest period of time for them to buy all year. But that number drops off in September, and that helps with the bearish seasonality in September. Is, if we could get an event as we get towards September, and you don't have the corporate buyback bid anymore, and that event triggers the systematics to sell, because you got to remember that CTA trend following trigger is going to continue to rise over time. That's when September, things could get really, really interesting if you could get any sort of a catalyst that triggers it. Because all of a sudden, we might find ourselves in the right environment to create more of a broader crash than these little 2-day pullbacks that we're only now starting to get, right? Up until basically the last day of July, we couldn't even really get 2-day pullbacks. Now we're finally getting these little couple-day pullbacks. The Fed on Friday, Jerome Powell on Friday, though, even though we're not in September and we still have the corporate buyback bid, has the potential to be an event catalyst to trigger the market lower, break the market technically, increase, turn on vol selling, turn on CTA trend follower selling. So Friday's potentially a really big day, and that circles back, and I'll leave it at this note. It circles back to what I kind of said in the beginning of today's meeting. Is today the pivot low in the uptrend that leads to new highs? Or is today that we just got a little bit of an oversold bounce in the oversold leaders like Palantir and NVIDIA that are just going to give way to more selling once they've satisfied some of that extension that leads to something more? There's a decent chance that Friday is it. Right? A lot of, I think I said this earlier in the week, but I'll say it again because now we're almost at Friday. A lot of times the Jackson Hole event is a nothing burger. Most of the time it's nothing burger. This Friday, it could be a nothing burger as well. 2022 is a major, major exception to the rule. Jerome Powell destroyed the market in 2022 at Jackson Hole. And I think that this Friday has a little higher of a potential of being a bigger event than a normal Jackson Hole, just because of everything that's going on right now. seeing inflation beginning to uptick as we're seeing the economy begin to slow down, as Jerome Powell is getting all of this pressure from the executive branch of the United States, all kind of happening all at once. You know, what's he gonna say? If he comes out, I think that there's a real chance. I have no idea what's gonna happen, but I think that there's a real chance that Powell comes out decently hawkish on Friday after the CPI and PPI are showing these inflation upticks that are potentially only the beginning of the iceberg. And if he says, hey, price stability is, he said this, and I keep saying it, 2 Fed meetings ago, maybe 3 Fed meetings ago, that for me when he said it was very eye-opening. The Fed has a dual mandate: maximum unemployment and price stability. That's the dual mandate. The question that was posed to him in the press conference at that time was basically which one is more important. If the Fed is put in a situation which has not happened in decades, where both sides of the mandate are worsening at the same time, unemployment is worsening while inflation is rising, which side of the mandate do you pick as more important to focus on? That was the question. And, again, tariffs are stagflationary in nature, so that's what's causing this. It's causing a slowdown in the economy with an uptick in prices at the exact same time. The question is the uptick on pricing just, temporary, a temporary one-time uptick from tariffs that then goes away or not? It's hard to be able to really answer that question. It easily could be. But the question that was posed to Jerome Powell a few Fed meetings ago was, in basically a stagflationary environment, which side do you choose? Do you keep interest rates high to fight inflation, or do you lower interest rates to improve employment? And what he said was, you cannot have steady maximum employment and a good labor market without having price stability. So basically, the read-through on that to me was, if he's forced to choose between both sides of the mandate, he would choose price stability first. That means higher for longer on the interest rate front before then tackling the employment side. And it's a tough situation to be in, but these, last 5 economic numbers in a row have all been giving us stagflationary data, and the market is still pricing in, last I saw, an 85% probability of a September cut. We still have a couple numbers that are going to be August employment numbers and things like that before the September Fed meeting, but we don't have those numbers yet. And just based on how Powell was even on the last Fed meeting, he came out more hawkish. I think people forgot because it was so quickly followed by Microsoft and Meta earnings, and then so quickly followed by the non-farm payrolls number. But you almost can't even see it here on the daily chart. On July 29th, which was the last Fed meeting, he came out more hawkish than the market expected. And we were weak on that day because of it. And Microsoft and Meta kind of saved things, and then it got overshadowed by the bad non-farm payrolls number. And the bad non-farm payrolls number is actually what led to the increase in the higher probability of the cut occurring, because they're like, oh, employment's getting worse via this non-farm payrolls number, therefore we have to cut. That's not necessarily true that he has to cut if that employment's getting worse, but at the same time, inflation is also getting worse. So I think that you have a potential downside catalyst if Powell comes out and he is very hawkish, when the market is pricing in an 85% probability of a cut in September. So I would argue that the risk is to the downside for Friday. That's not to say that he might come out and be dovish, and then by the end of him talking on Friday, we have a 100% probability of a rate cut in September, or even pricing in a little bit of a 50% cut in September, and the market's moving higher on that for all I know. But given the way that he spoke at the end of July, given the degree to which the cut is being priced in already for September, I would argue that the risk is to the downside on this event, but only Friday will tell. 82.6% probability of a cut for Friday, for September. Thank you, Bill. All right, gang. I'm gonna wrap it up there. Great afternoon meeting, guys. The best afternoon meetings are always because you guys ask great questions. So, great questions from Scotty, TG, a couple people on the YouTube. Keep that stuff up. That's what makes the really good meetings. Have a great night, everybody. See you all tomorrow.